Welcome to All Sides with Amy Juravich. According to Realtor.com, the average age of the first-time homebuyer is 40 years old, a record high. Skyrocketing home prices and limited housing stock have turned the dream of home ownership for many into a nightmare. The Trump administration is floating an idea to help making home buying easier: a 50-year mortgage. However, fellow Republicans and financial experts have their doubts. Tommy Aiello is the Senior Director of Government Affairs for the National Taxpayers Union, a nonpartisan anti-tax advocacy group. Welcome to All Sides, Tommy.
Good morning. Thanks for having me.
So how would a 50-year mortgage work versus the 30-year mortgage that we're all used to?
Let's just take a step back and see why we're having this conversation, right? I think all Americans agree, regardless of your politics, that the rent's too high, homes are too expensive, and people are falling behind. We see that in the data, and you just pointed out that the average first-time home buyer is 40 years old. That creates a lot of pessimism for the younger generations, including in my generation, that we're falling behind and unable to get ahead. And that's what the president recognizes, and his team wants to come up with very creative ways to help solve the problem. The 50-year mortgage, it sounds good on paper, but if you dive into the details, people are going to pay more, they're going to pay longer, and they're going to be trapped in debt for longer. We think we need to actually identify and solve the root problems of the housing problem rather than just, creative ideas that ultimately won't help people at the end of the day.
Now, this 50-year mortgage is getting a lot of buzz. The idea is that you'll save a couple of $100s a month, and that's appealing on your monthly mortgage payment. But the flip side of that is paying an extra 20 years of interest above that 30-year mortgage. So that might not be as appealing. What's the short-term versus the long-term idea for you?
It's certainly a mixed bag for potential home buyers. We ran some of the numbers, and if you're purchasing an average home of $400,000, you might say, compared to a 50-year mortgage, compared to a 30-year mortgage, you might save about $250 a month. And that's a lot of money for a lot of people, right? That's 2 weeks worth of groceries or maybe a month's worth of gas. On the flip side of that, however, is you're going to be paying almost $400,000 more in interest over the life of the loan. That's almost the cost of the house you're trying to purchase. So you're paying much more over a longer period of time. You're trapped in debt longer. And even though you're saving in the short term, you're going to be paying so much more in the long term. And I don't think that's what people want at the end of the day. They don't want to be trapped in debt longer.
So people don't stay in their house usually for 50 years. I read that most people either move, downsize, or upsize on average around at the 12-year mark. So in that case, maybe a 50-year mortgage is an okay deal if you only stay in the house 12 years. How's that work out?
I think when we're talking about this conversation, we think, okay, my rate will probably be about 5%, 4% maybe if rates continue to decline. Banks will need to charge a higher interest rate for your mortgage because they're going to operate under the assumption that you're going to be in that house for 50 years. So they're going to have to charge a higher interest rate, potentially as high as an extra point or a point and a half compared to a 30-year mortgage, because they have to hold that loan on their books longer. And a lot can happen over that 50 years. Perhaps a homeowner loses their job, they fall behind on payments. They need to take all of those risks into account. And 50 years is a very long time for a bank to have a mortgage on their books like that. So it might sound good, but at the end of the day, people are going to pay more in interest rates than they would normally on a 30-year mortgage and much more than they would on a 15-year mortgage.
Yeah. So what about the interest rates? If interest rates overall went down a point or two, wouldn't that also save a couple $100 a month on the mortgage payments?
It would. We also calculate that's another $200 or so a month if you were to refinance. But refinancing costs money as well. So it's not just a free money to people. You have to pay thousands of dollars in order to refinance. Now, if you're a first-time home buyer, right, you're eligible for a number of federal programs that help you with a lower down payment. And as rates continue to decline, that'll mean more money in people's pockets. And that's why the president is making such a big push for the Federal Reserve to cut rates. Now, that's just on one side of the equation. How do we increase the housing supply? How do we build more housing, more apartments, more multifamily units? Unfortunately, there's not much the federal government can do in this regard. It's really these local governments, mostly in high cost areas that drive up the cost of housing with regulations and ridiculous rules that make it impossible or near impossible for builders to build. So when we talk about this national conversation, it's important. But the most important thing is we get it right at the local level. And I think that's where the next conversation needs to be.
Okay, so there's not enough houses to buy. So is that making them all more expensive?
It is. I mean, if you look at some of these areas, like, we all talk about, I'm from New York, right? So New York is an extremely expensive place. Los Angeles, Chicago. Why are those areas so expensive? Well, over the past 15, 20 years, they've put up so many more barriers to building. So it makes it harder for developers to come in, not only to make a profit, but also to just to build. In California, in Los Angeles, for example, you need parking minimums. For every unit of housing, you need to have a parking space. In some areas, you need to have electric vehicle chargers. 20% of all the parking has to be electric vehicle parking. So those are costs that get added on to builders. And then builders, they might say it's not economical for me to build here, or it's more expensive for them to build, and they have to pass those costs on to renters or home buyers. So it's all of these things that start to add up, right? These nickels and dimes, they do add up. And some areas have actually made an effort to reduce these barriers, and kudos to them for doing so. But there's so many jurisdictions that are just dragging their feet in order to do it, and it's really holding their economies back.
This is All Sides on 89.7 NPR News, and we're talking about whether the 50-year mortgage is a good idea with Tommy Aiello, Senior Director of Government Affairs with Taxpayers Union. Another thing that's being floated by the Trump administration is the idea of portable mortgages. Portable mortgages would allow homeowners to keep their existing interest rate and the terms of the loan instead of paying off the loan if they go to get a new one. So this type of mortgage, it can be found in Canada. Other countries use it. Is it feasible in the U.S. market?
It remains to be seen if it's actually feasible. And again, the president and his team are coming from a good place. They're getting creative in how we come up with these solutions. A portable mortgage is interesting and perhaps it's more feasible than the 50-year mortgage, but it's just really untested in the United States. There's a lot of reasons why why it could hold the market back, right? If you purchase a $400,000 home, maybe you lock in your interest rate of 4%. If you go to sell your home and you want to purchase a bigger home, maybe 15 years later, maybe at 700,000, you're only locked in on that interest rate on the first 400,000. So you're going to have to get another rate, a supplemental rate to cover that additional balance. So it does lock in originally, but over time, if you do want to end up moving your house, you're going to have to pay a little bit more on a higher interest rates. So it really becomes this problem where it's okay in the short term, but it doesn't solve your problem in the long term because housing prices usually always go up. So it's a problem that's going to have to be solved by the administration if they do want to move forward with this.
So why does it work in Canada and other countries? Why wouldn't what makes us different?
It's a little complicated, but we have a lot more financial plumbing in our housing market. Fannie Mae and Freddie Mac, they are the ones that, purchase most of the mortgages. They repackage it into something called a mortgage-backed security, something we might remember from the 2008 financial crisis. It becomes much more tricky to package those types of mortgages. If you have a portable mortgage rate, they really rely on these conventional mortgages that are your 15-year mortgages, your 30-year mortgages. So it becomes more complicated for the financial plumbing of our system to package up these portable mortgages and sell them off to different buyers. And why is that important, right? It sounds very complicated. Well, the buyers and sellers of these mortgage-backed securities are the liquidity that keeps our mortgage system running. It enables banks to move these mortgages off their books and make more loans to more buyers. More loans typically means lower rates for most people. So when you add this wrench into the system, we don't know exactly how it's going to turn out. And I think that's why you're seeing a lot of experts sort of pan this idea of a portable mortgage because it could undo a lot of the foundations of our mortgage system. And we just don't know how the market would react to such a change.
We mentioned earlier, affordability. We've talked about interest rates. We've talked about low housing stock as all as barriers to home ownership. Is there anything else standing in the way for people who want to buy a house that we haven't mentioned?
When it comes to building homes, right? We mentioned how local governments are standing in the way, but there's also more the federal government can do, right? The president has imposed these massive import taxes, these tariffs on places like Canada, China, and Mexico. All of those places send goods to the United States that are integral for building housing, right? Canadian softwood lumber, almost all houses in the United States are built with softwood lumber. So if you tariff those things and appliances and copper for copper piping, it becomes more expensive to build. And when it becomes more expensive to build, those costs get added on to home buyers, which means their house becomes more expensive and they need to take out a bigger mortgage. And a bigger mortgage means more interest at the end of the day. So there's little things like that that are driving up home prices. And if the administration does want to bring home prices down, we think it would make sense to stop the tariff policy and reset back to where we were on January 20th before the tariffs.
Uh, Back to the 50-year mortgage for a minute. Would banks even want to take this on? Do banks want a 50-year mortgage?
Yeah, I mean, right? It's 50 years is a long time.
Mm-hmm.
That's 5 decades, and I don't think banks want to obviously make loans. That's how they make their money, and it could be attractive to them because they know they would make more interest, potentially double the amount of interest they would on a 30-year mortgage. So that from that perspective, it makes sense. But there's also risk involved with that, right? We touched on the fact that 50 years is a long time. A lot can happen in a person's life that could cause them to fall behind on their mortgage. And when you hold that 50-year mortgage on your books, it becomes extremely risky. And, the 50-year mortgage, you might have to charge a higher interest rate than you would on a 30-year rate to account for that interest. So I think banks would be interested in offering the 50-year mortgage. I just don't know how much demand from a consumer side there would be for such a rate.
Obtaining mortgages is already a challenge for minorities. Would a 50-year mortgage be even more of a challenge, or would it be easier? I'm not sure.
I'm not really sure either, to be honest with you. I mean, if you look across the board, right, it could be attractive for working class people because they know that they might save $250 on their monthly bill. Or their monthly mortgage payment. That's a very big deal for a lot of people, and it would help them cover some of the more expensive goods and services that have skyrocketed over the past few years. And if you're taking that extra $250 and just applying it to your mortgage, making that extra mortgage payment every month, maybe the interest wouldn't be as bad. But again, most people don't do that. Most people don't make those extra payments. They say they want to, but they don't. So I don't think it would impact minorities or other groups more than they would, but I don't know how it would impact them specifically.
Now, you mentioned earlier there's a lot of regulations before this could even be considered to go into effect. The Dodd-Frank Act that you mentioned earlier does not even allow for a mortgage to be longer than 30 years. So how do you change that?
Well, you'd have to go to Congress and change the law. And I think, from what we're hearing from members of Congress on Capitol Hill, especially on the Republican side, is there's really not that much appetite to do anything here. I believe you had just, 4 or 5 members of Congress tweet about it, that it was a bad idea on the Republican side, and that'll basically kill any chance of it actually moving forward. Now, that doesn't mean that there isn't an appetite to do something on housing. In fact, the House Financial Services Committee, they're hosting a hearing in early December about the core drivers of housing costs. And this is a very bipartisan area. So you might see a few more bills introduced that are bipartisan to address the problem, particularly around land use policies and zoning at the local level, and making sure that localities that are receiving federal funds for affordable housing are actually changing some of their laws to build more housing. So it's little things like that that I think have more legs than they would with changing the laws to try and change it to allow a 50-year mortgage to be backed by Fannie Mae and Freddie Mac.
So just to end on 50-year mortgage, good idea, bad idea? What should we give up on this and be trying something else?
I do think it's a creative idea, but we should really stick with the proven solutions that could drive down housing prices, right? That's, land use, zoning reforms, reducing some of the tariffs, permitting reform at the federal level to build roads that go to these communities. and favorable tax policies. This is something that every business responds to incentives. There were a lot of really good tax policies in the one big beautiful bill that the president signed over the summer that'll spur more housing development. I read one recent report that said because of the passage of that bill, we'll be able to create 1 million more housing units over the next decade. It's a drop in the bucket for what we need, but it's real change that'll actually help real people, hopefully over the next 10 years if those units were to come online. So it's little things like that that start to add up, and I think would actually make more of a sizable difference for people than a 50-year mortgage.
Our guest has been Tommy Aiello, Senior Director of Government Affairs with National Taxpayers Union. Tommy, thank you so much for your time today.
Thank you.
Coming up,